Hello, everyone. I can see the participant count is rising, so I'll give it a couple more minutes before we get started. Okay, I think we'll get started now. I can see some people are still joining, but I'm conscious we just have 30 minutes allotted for today's webinar. So let's get started. Hi everyone, happy Friday. Thank you all for joining today's webinar all about the ICARA. Just a quick introduction before I hand over to my colleague Panagiotis. This session is designed to be an informative and very practical one. So we will be providing clear steps to help you kind of refresh and rebuild your ICARA. Let's get straight into it. I'll hand over to our speaker, Panagiotis, who brings extensive experience on this topic. Panagiotis, over to you.
Thank you, Ashley. Good morning, everyone. My name is Panagiotis Vasiliadis, and I am an assistant director at ComplyPort here in London. For the last decade, I work closely with a wide range of financial institutions, including banks, investment firms, fund and fund managers, electronic money institutions, and other financial institutions across the United Kingdom and the European Union, supporting them with their prudential regulatory requirements and risk management frameworks. It's a real pleasure to be with you today as we will discuss key steps to follow to further enhance your ICARA processes. So let's get started. Since the implementation of the IFPR back in 2022, firms have had to shift away from the old ICAP and ILAP frameworks and embrace something new, the well-known now ICARA process. After 4 years since the implementation of the IFPR, the ICARA isn't just a rebranding exercise. It's a fundamentally different way of thinking now about your capital and liquidity adequacy position. It is integrated, it is forward-looking, and it is designed to reflect how your firm actually operates, not just how it is structured on paper. So, in today's session, we are going to break this down into four different key areas. First, we will look at the common weaknesses we have seen across firms during these 4 years. And I mean real examples, not just theoretical ones. These are the recurring issues that trip firms up, and we will show you how to avoid or rectify them. Second, we will walk through some targeted improvement areas. These are practical steps you can take to strengthen your ICARA, things like clarifying your business model, improving the stress testing design, and making your wind down plan actually executable. Third, we'll touch the MIF 007 return submissions. This is often treated as a tick the book exercise, but it's actually a critical checkpoint for consistency and credibility of your ICARA process. And finally, we will wrap up with some key takeaways, how to embed ICARA as a living process within your organization and use it to support resilience and informed decision making. Now, before we talk about how to improve your ICARA, let's be honest about where things tend to go wrong. Since the implementation of the IFPR, we have reviewed hundreds of ICARAs across the market for different type of firms, and the same issues keep coming up. First, we are seeing overly descriptive documents, firms spending pages talking about governance structures and policies, but they don't explain how risks are actually managed day to day. The ICARA ends up sounding like a handbook, not a risk assessment as it is. Many firms are just copying and pasting information in the ICARA process from other documentation or policies that they have already established without connecting this information and data to the main scope of the ICARA, which is at the end of the day the calculation of your overall threshold requirements with respect to capital and liquidity resources. Second, we noticed the weak linkage between the business model and the risks identified. The harms and the risks that you are identifying during the process, in some cases, are just listed generically in a simple structured risk register without any connection to the firm's services or permission that it is authorized to offer, without taking into consideration concentration risk, operating models, etc. It is in some cases it's like reading the risk register in isolation rather than a part of a holistic ICARA process. Third, we have seen inconsistent capital and liquidity assessments. The assumptions used in each of these assessments are misaligned or duplicated, which leads, of course, to unclear or even conflicting conclusions. Fourth, the stress test designs are too mild or unrealistic. So we have seen scenarios that assume quick bounce back when in reality stress events are prolonged and messy. Also, many firms missing of taking into consideration the correlation among the variables, and they are only performing sensitivity analysis without taking into consideration potential impacts that change or, for example, a regulatory fine, how this will affect other variables within your financial position. Fifth, we'll discuss about the wind down plans. In some cases, the wind down plan, we have seen that in some cases the wind down plans have been designed from the financial point of view rather than from operations. This type of plans overlook key dependencies, resource needs, and real world execution challenges. And last, we have seen generic recovery actions that they lack specificity, measurable impact, and defined ownership. It's not enough to say we will raise capital or reduce cost. You need to show how, who is responsible for this action, as well as how the board of the firm is oversight this process. We will discuss each of these areas and some more in the next slides, and we'll see one by one each category. So let's start with the foundation of the ICARA process, which is your business model and operations. This is where the ICARA begins. It should be considered as your starting process of this, as a starting point of this process. If this section isn't sharp, everything else will feel disconnected. Now, what we often see in firms using is firms using generic descriptions. They list their permissions and sometimes their products, but they don't explain how those services are delivered, who their clients are, or how their income is expected to be generated during the ICARA process period that you are examining. So, what does good look like in this case? You need to clearly define your regulatory permissions, of course, and the client types that you can offer these services. You need to keep the descriptions strategic. This isn't you should not treat the ICARA as a marketing pitch. Anyway, the market participants will not see it. It's only you and the regulator. And in some cases, they are also considered the ICARA as a compliance checklist. This is not the case. It's about showing how your firm operates in practice. So to be able to connect these operations with the next exercises, which are the risk identification, the financial forecasting, and capital and liquidity planning. You need to map the client journey, of course, from onboarding to service delivery to exit. Each stage carries different type of risk, and understanding this whole journey helps you identify where harms might arise. You need to also disclose your key revenue streams. If, for example, the 80% of your total income comes from one product or one client, that of course raises concentration risk and it needs to be flagged within the ICARA. And finally, you need to link your business model directly to harm identification and financial resource planning. This isn't just about an introductory paragraph or an introductory section within the ICARA process documentation. It's the foundation of your whole ICARA process. All right. Sorry. All right. Now let's talk about financial projections, and this is where things are starting to get difficult for some firms. We have seen ICARAs with forecasts that are either too optimistic or completely disconnected from the reality. They do not reflect the actual business model, historical performances, or even the risk that the firm is currently exposed to or it is expected to be exposed to. So what do we want to see here? You need first of all to start with a 12 months forecast broken down into quarterly or monthly if you have the granularity. This isn't just about showing growth, it's about showing the resilience of your firms. Your revenue, cost, and cash flow projections should always align with your business model and the risk profile that we have explained in the previous slide. And of course, assumptions. They need to be clear, they need to be tested, and they need to be challenged. If you are projecting, for example, a 30% increase in revenue, you need to explain why. Is it based on new mandates, new based on market trends, maybe pipeline visibility? Also, you need to make sure you distinguish between the business as usual and stress conditions. What does this business look like in a downturn? What happens if you lose a key client or face a market shock? All this should be covered and taken into consideration in the design of your normal and stress testing financial projection exercises. And finally, uh, you need to have in mind that these financial projections should be linked with the capital and liquidity planning that you will perform in the next exercises that we will discuss in the next slides, which includes the overall threshold overall capital threshold requirement and overall liquidity threshold requirement. So let's move into additional harms and capital. This is the part of the ICARA that often gets overlooked, but it's critical. It's about identifying harms that aren't fully mitigated by your controls and quantifying the capital you need to cover them. Now, what we often see is firms listing harms without any attempt to quantify them, or they ignore emerging risk altogether. And when they do add capital, there is no evidence or rationale behind the calculation. So, what's the fix? Start by identifying harms that remain after controls are applied. You need to use your risk register to support this. It should show the residual risk, not just the inherent risk that you have estimated for a specific risk. Then you need to quantify each harm, each risk using a proportionate modeling. A simple probability versus impact model can go a long way here. You don't need a complex Monte Carlo simulation or anything like that. Just a credible probability versus impact model with defensible assumptions. You need to also take into consideration emerging risks. For example, if you are launching a new product or expecting to enter into a new market, you need to ask yourself, what are the unknowns? How am I monitor? I will monitor this new risk that will maybe arise. And when you add the capital using this model, you need to justify it. Show the board approved national. This stage is very important to be submitted to your board for to ensure that it is approved by the board, because this is should be linked back to the business model and the potential operational exposure that you might have. This is about showing that your capital buffer, that the additional capital and liquidity the additional capital you are estimating is not just regulatory, but it's strategic as well. Now, let's talk liquidity here. And this is where we see some of the biggest gaps. Too often firms base their liquidity planning on static financials. They don't forecast forward, they don't break down business as usual versus stress conditions, and they include assets that aren't even eligible under MIFIDPRU. There is a huge misunderstanding of what type of items are eligible to be included in the calculation of liquid assets. So you need to tighten this up. First, firms must review the MiFID rules again. They need to make sure the assets are are eligible to be counting as either core or non-core liquid assets. If they don't, they shouldn't be in your calculation. Second, firms must define the methodology. How are you calculating your liquidity needs? Not only based on the basic rules of the one-third of the fixed overheads requirement, but the overall liquidity needs to ensure ongoing activities. What assumptions are you using, and are those assumptions consistent with your stress testing and wind down planning? Third, to be able to do all this, you need to have efficient forecasting in place. Again, 12-month forecast horizon is adequate. So to perform this exercise, you need, as we said, we need to break it down either quarterly or monthly, including operational resource coverage, such as salaries, rent, tech subscriptions, and of course, contingency funding that you may have in place. And finally, the liquidity model should be integrated into your treasury and finance processes. Liquidity planning shouldn't live in a separate spreadsheet on someone's desktop. It should be part of your firm's financial DNA. And this is how it should be treated. Now, let's shift to governance, and this is where credibility is either built or lost. We often see CARAs that describe governance in theory. They list roles, committees, and responsibilities, but they don't show how governance actually works in practice. Board involvement sometimes is passive. There is no evidence of challenge, no escalation routes, and no link between governance and the ICARA outcomes. So firms should start by showing how the board and senior management is engaging with the current development, the preparation or update, not just be involved in the sign of the ICARA or the approval, but shaping the whole framework by challenging the assumptions and approving key decisions. The stress testing and harms identification are decisions that needs to be approved by the board, or at least to be the board to be aware of these exercises, of the outcomes of these exercises. Firms need to document the challenge process, who raised these concerns, what was escalated during this meeting, and what changed as a result following this discussion. The governance should also be linked with core components. As we said, the stress testing, wind down planning, recovery actions as well. You need to also, as part of these governance requirements, to assign ownership for maintaining the ICARA, make it clear who is responsible for updates, reviews, and oversight. And finally, demonstrate how ICARA informs strategic and operational decisions within your organization. This isn't this is actually about embedding the framework into the firm's daily operations. What we are going back, what we are always advising our clients is to treat the ICARA as a living process within your organization, not just another annual reporting obligation. Now, moving on to the risk management, this is where firms often fall into the trap of describing structure instead of the substance. They talk about who is responsible, what committees exist, but they don't show how risks are actually managed. Firms need to start the preparation of these risk assessment processes to be established, embedded in the ICARA process. by describing how risks are actually managed in practice. What does your risk appetite look like? How are thresholds defined? And of course, what happens when something breaches a limit? So to do that, you need to use tangible metrics and assumptions that the board can challenge. For example, if your risk appetite allows for a 10% drop in the assets under management before escalation to the board, show how that's monitored and what happens next. What is the next step if I exceed this limit? We are advising our clients that having to establish a risk appetite statement using a red, amber, green approach. So to help them not only better monitor the risk exposures, but also quantify the actual limits your firm is allowed to be exposed given the current and future risk profile, and of course, tolerance. Next, you need to align harms with your business model. If you are a discretionary manager, your risks are, of course, different than if you are an execution-only broker. So having a well-designed risk register, it will help you identify, assess, mitigate, monitor, and make sure that the additional capital requirement that you will estimate based on the model we explained before is actually adequate to cover the residual risks for each harm you have identified. In this process of risk management assessment is where the governance meets the real world risk. Stress testing. This is where your ICARA process either comes to life or falls flat. We have seen firms run scenarios that are too mild, too short term, and too optimistic. They assume quick recovery when in reality, as we said at the beginning, the stress events could be messy, prolonged, and unpredictable. So it is advisable to use a mix of scenarios. Compliance stress testing, macroeconomic, or a combination between idiosyncratic and macroeconomic scenarios. For example, what happens if you lose your top three clients during a market downturn? That's a combined stress and will help you better understand how your business and your overall capital adequacy position will react during this period. You need to calibrate severity using historical data. And of course, don't forget about reverse stress testing. Ask yourself, what would it take to breach your capital threshold? We know that reverse stress testing is not that easy, especially for simple models. And sometimes it is not useful for straightforward model business. But it is always advisable to consider whether it will be good for you to have in place a reverse testing by starting with the assumption that my model has now become unviable and go back by using engineering and check what variables could lead to this unfortunate result. And of course, about stress testing, the most important one, you need to engage the board. They should be involved in scenario design, challenge, and approval. This isn't a technical exercise, it's a strategic one. Now, let's move to wind down plan, and this is where theory meets reality here. We have seen plans built entirely from financials with no consideration for operations. So you need to start from the ground up. Build a plan from operations, assess your overall process and procedures, not only the financial position of your firm. Identify the dependencies, systems, people, third-party providers, and map out the steps needed to wind down each one. You need to test your assumptions, run scenario walkthroughs. If you say you can exit in 3 months, is feasible? And finally, firms must have in mind the FCA's wind down guidance and policy statements that have been issued. So to structure your approach, and make sure that you meet the regulators' expectations, and also have in place an executable plan, not something just to tick the box that I have prepared the wind down plan and embedded it in the ICARA process, but also have a plan in case you decide to exit the market to be able to use it and avoid any extra cost or risks that may arise. Recovery actions. We have seen the generic statements here, like I will reduce my cost, I will raise capital, but there is no detail, no trigger, no owner, and no sense of feasibility. So you need to sharpen this. Define each action clearly. What is it? What's the expected impact? What are the risks? And what's the trigger? And of course, who is monitoring this? This is very important when a recovery action is deployed to make it clear who is responsible to monitor the implementation of this recovery action. Because if this recovery action isn't implemented well, you will go back where when you were in breach. You need to also test feasibility. Don't just list actions in the ICARA process, but also walk through them and present the outcomes after the recovery action is implemented. And of course, the recovery actions should be aligned with the wind down triggers that you have established, and of course, early warning indicators. And make sure that these are measurable. This process isn't about showing that your firm can respond, can react, but respond to the potential violation. Now, let's see how the ICARA is presented, because the structure matters. Is the document that the reader, that anyone could read and understand your approaches, your methodologies, and the outcomes, of course. We have seen ICARAs that are overly long, overly descriptive, and hard to navigate. Appendices are disconnected, or data tables are dumped at the end with no explanation. So to fix that, you need to use a clear logical structure. Start with an executive summary that highlights the key conclusions and the board decisions. Then walk through the business model harms, capital, liquidity stress testing, and link each section back to the business model and the material halves, because these are the main the main sections within the ICARA. So it is also advisable to use diagrams and tables to make it to support clarity and flow within the ICARA report. Now, let's see how to keep ICARA alive. Because too often it is treated as one of annual exercise. We have seen firms with no formal review triggers, no update schedule, or no ownership. The ICARA sometimes are get filled and then forgotten. That's a risk. You need to establish a formal review and update cycle. For example, we usually say that the update should be annual unless any of the underpinning assumptions within your ICARA is changed. So you need to take actions and review and update the report. So you need to assign ownership in that case. So someone needs to be responsible for maintaining the ICARA inputs and outputs. And that responsibility, of course, needs to be documented. So someone should review in case you have decided to, for example, enter a new market. That's a very important development within your organization. So the ICARA must be reviewed. In that way, you are turning the ICARA into a living framework, into a living process, not just a static report. Now, and about the submission, about MIF 007 return, this is where everything needs to be aligned. MIF 007 is the FCA snapshot of your ICARA. It includes key data points, capital liquidity, wind down cost, recovery actions, and it must reflect the same logic, assumptions, and conclusions. The FCA offers in the MIF 007 return a box where you can analyze the potential risk that you are exposed, so take advantage of this space to communicate to the regulator the details you want them to know for you. So make it a governance milestone, not just a compliance task. You need to get involved the risk, the finance, and compliance in the review. This will help you make sure that all key personnel within your business are aware of the ICARA assumptions and outcome. And of course, the submission of the MIF 007 is your chance to demonstrate control, coherence, and credibility. So let's wrap up with the big picture. ICARA isn't just a regulatory requirement, it's a strategic framework. The strongest ICARAs are clear, not just focus analysis. They are proportionate, tailored to the firm size, complexity, and risk profile. The success of an ICARA depends on board ownership, not just sign off, but engagement on quantified assumptions, credible tested, and credible to be tested and challenged. And at this stage, we want to give you something practical. As registrants of this webinar, you have the opportunity to take this further with us. We are offering two distinct options depending on your needs. The first option is a CARA report. This is a focused health check where we will review your existing current documentation, test it against FCA's expectations, and provide a structured feedback report. The deliverables of these options include a gap analysis and a set of prioritized recommendations and a short debrief session with your team. It's ideal if you already have a draft ICARA and want further assurance. The second option is a full ICARA preparation. This is end-to-end support. We will work with you to design, draft, and finalize the entire ICARA process. The deliverables here are more extensive. We will provide you a complete ICARA documentation, including report and workings files, all aligned with MIFID rules. A ready to submit MIF 007 return and 1 hour virtual presentation of the ICARA outcomes to the board. It's the right choice if you want confidence that everything is built from the ground up to regulatory standards. Both options are available exclusively to webinar registrants, and we will tailor them to your firm size and complexity. The key is that you walk away with a regulatory aligned documentation and clear assurance that your ICARA stands up to scrutiny. In addition, all webinar registrants will receive a recording of the session and complimentary access to our virtual compliance assistant, including 20 free queries to explore our platform. No subscription or payment are required to check it out. So yes, that's all from my side. Thank you all for joining us today. Ashley?
Thank you, Panagiotis. Those are very, very valuable insights and tools building an effective ICARA. So thank you for that. I can see that we have some questions in the chat. We would love to continue the discussion, but we do need to wrap up. I know we have gone over the time slightly. We were allotted 30 minutes. So thank you all for staying on until the end. We hope you found this session insightful. For those of you that have submitted questions, we will follow up after the session. And if anyone has any kind of queries or questions at all, feel free to reach out to Panagiotis or me. We'd be more than happy to hear from you. So thank you again, everyone, and have a great day ahead. Bye bye.